global financial services landscape today, in September 2015, is unrecognizable from that which existed at the turn of the century. Massive advances in technology, software, hardware, and communications infrastructure, coupled with a profound cultural shift as the digital generation, people who have grown up in a connected online world, joined the workforce, has driven unprecedented change and the emergence of an entirely new paradigm.
Of digitally native intermediaries is emerging, and with this will come a new economy, new systems to store and exchange value, a system immune to the corrosive effects of monetary debasement, artificial scarcity, and over-centralization. A system that is too small, too simple, and too distributed to fail. A system where complexity is simultaneously hidden away while being harnessed to create value for its users.
For the first time, we are seeing the adoption of technology by consumers, superseding that of businesses. We're also seeing the emergence of peer-to-peer networks in the financial services arena that seeks to disintermediate traditional institutions. At the same time, there are pioneers who are using behavioral economics and gamification to innovate in the mainstream, as well as to solve the issues of financial inclusion and education. You need to think about digital financial services as a way of delivering services at very low cost. Why is that? The reason behind that is that the cost of a marginal transaction to be done digitally is close to zero, which means you can really serve consumers at an extremely low cost base once you create scale in a system. And I don't actually believe the way that's going to get done is the way it's got done in the West, where we've built basically vertically integrated institutions to do that. I believe the way it's going to get done is through something called competition, the creation of ecosystems where people not only work with each other to cooperate, but also compete with each other.
Inner Tribe. Please welcome co-founder of Anthemis and Apis Partners, Uday Goyal.
Good morning, everyone. Welcome to yet another year of the Future of Money. Really excited. And just as a starting point, the reason we put that video together was just to give you a flavor of what we've been trying to do with the Future of Money, I think since 2011 when we started to do it, which is to do a bit of crystal ball gazing. The first clip you saw there was actually a video produced by my co-founder of Anthemis, Sean Park, and he put something called Amazon Bay, and the idea behind it was to talk about how distribution in financial services was fundamentally going to change in the next 10 years, and 2015 was going to become a pivotal year, and that was 10 years ago. It's amazing to think back that long. And then in 2010, the Financial Reformation video talked about distributed financial services, actually predating even Bitcoin and blockchain. And today, for those of you who attended the session downstairs, which was standing room only, Bitcoin and blockchain has become a big topic for people here at Sibos and in this room. So really, we've tried to do it, and I think following on from last year's blockchain debate on this stage, this year the idea was to showcase what we think is the next big trend. So what is the next big trend in our mind? We think that the big disruption that's coming is at the heart of the financial services industry, which is credit. As you know, credit is probably the single biggest revenue driver of most institutions. It's a mixture of credit and payments and transaction banking, etc., but credit. And the people who you see on this stage today are people who are fundamentally disrupting the way credit is thought about, the way credit is scored, the way it's distributed. They're in different markets. They're going to talk a little bit about their businesses. And fundamentally, they're really reinventing that. But at the same time, we have to remember that the big pools of capital in the world sit within your institutions and with some of the people you're going to hear on the backside of the auditorium. And the question is, how do we bring these two sides together? I talked a little bit in that TED Talk, and for those of you who want to see the full one, that's tomorrow during the financial inclusion session, around this idea of competition, the fact that you can actually compete and collaborate at the same time. And I believe that the future of this industry is all around competition, and there are innovators who sit on both sides of the table who are starting to make that a reality. So we have to think about the evolution, and in my mind, standing still isn't an option for people, because outside of this room, we have people like the telcos who are very actively starting to get engaged in this industry. We have people like Google, like Amazon, like Apple. Amazon is already lending in much the same way that some of the people on this stage are. The rest are going to come in very quickly. And so the question is, if you don't innovate, and if you don't collaborate, and if you don't cooperate, where does that leave you? Where does that leave you for the future? And I think that's what we're going to try and think about and talk about today. So with that, I just want to hand over to my co-presenter, who's somewhere at the back. Kevin, over to you.
Thank you, Uday. So first of all, thank you so much for coming in. You don't have to turn around. I think we're going to, yes, we're all going to be on the front as well. So behind me, I've got a panel of bankers as well. What we're going to do, we're going to sort of talk to the guys at the front, we're going to talk to the people at the back. But before we do that, we wanted to get to know who's in the room. Now, we're going to have a slight problem because the way we're going to get to know who's in the room was through some digi-voting, and not everybody's going to have one. I think everybody who's got a seat should have a digi-voting token, which looks a little bit like this. So we've got a couple of questions just to sort of try and take the pace of the audience to help us on our way. So, if we could get the first question up, please. So, how would you describe yourself? So, we've got a couple of demographic questions to try and feel who's in the room. Would you describe yourself as a baby boomer? Somebody from Generation X? Generation Y? Would you describe yourself as a millennial? Or somebody from Generation Z? I'd like you to just choose the number that represents where you think you are, and I'd like you all please vote now. Okay, so quite a few Generation X. Now, obviously this is probably about 50% of our audience, but I think we're going to have to take this as a sample. So we've got a couple of other questions. So the next question we'd like to ask is whereabouts you see yourself in your role. Do you see yourself somebody who's more towards the front end, towards the back end, or are you a startup? Because I know we've got some of the startups in the room as well. So if you could please vote now. Okay, so almost a sort of 50-50 between the front and the back end. This is going to be an interesting afternoon. So first, and again, thank you for making my job difficult, because I've actually got to walk amongst you guys and give you a microphone. So it's going to be interesting. We've got a couple more questions just to see how familiar you are with some of the technology that the fintech startups are using. So if we could go with question number 3. Okay, so we're going to ask this question again at the end of this debate to see if we've actually moved anybody's opinions. But do you believe that change at the back end of banks is being driven by new entrants at the front end? It's a 1 to 5 scale. 1, if you strongly agree with the statement. 2, if you agree. 3, if you sort of neither agree or disagree. 4, if you disagree. And 5, if you strongly disagree. If you could please vote now. Okay, so quite a lot of agreement. Now, the reason we asked you the first demographic questions is we can actually now show this by demographics. So, can we show this by people on the front end, back end? So there seems to be a fairly even split between everybody. So we seem to have a very good mixed crowd to start with. Now, the final question that I've got for you, question 4, is not whether you believe something, but it's how familiar you are with the technology. Now, these questions are a little bit different, because instead of selecting one answer, you can select all of the ones that apply, and once you've done that, you press the little green button on your voting pad. So, we're going to ask, have you used any of the following? have used person-to-person payments, person-to-person lending, cross-border? Have you done cross-border payments? Have you used an Airbnb, an Uber, or a PayPal? So I'm going to ask you to select all of those that apply, and then at the end, press the green button. So we're going to get a little bit longer to vote this time, but if I could ask you to all vote now. Okay, so the room's used everything across there. Not too many people have used peer-to-peer lending. Most people have used PayPal. Okay, Uday, I'm going to pass this one back to you. Thank you.
Fantastic. Thank you, Kevin. So let's kick off our panelists and a little bit and understanding a little bit about their business. And I'm very proud to present Creditec and Alexander. Alexander is one of the founders of Creditec. Creditec was founded in 2012, has 245 employees, and as of last week has raised $110 million of capital. I believe them to be one of the real innovators in this space. So without further ado, over to you, Alexander. Tell us a bit about your business.
Thank you, Uday. Great to be here. So we at Creditec, we have eventually, we're a tech-enabled consumer finance company, and we have come up with basically a completely new approach on how we do underwriting of consumer credit. And the starting point was that we eventually thought that underwriting on the consumer side is eventually broken around two dimensions. So first of all, from a customer point of view, I think it's still very painful to apply for a credit. I mean, think of going to a branch, bringing like a bunch of documents and so on. It's hard to explain that, why this is necessary for credit, while you can still basically buy everything online and so on with a single click. And the second thing in underwriting that we think is broken is the fact that still large segments of the population are actually excluded from most of the financial institutions by the way how their scorecards are designed. Think of thin file people or people, where there's simply not enough data around. And what we thought is, given the fact that there is actually more and more data, coming from the fact that people use social networks, that there's the app economy, that there's a lot of information just basically flying around. So we thought, okay, can't we use that data to actually compile some form of alternative credit score with it? So we have developed a system that captures up to 20,000 data points per loan application and is using machine learning algorithms to process that into a form of risk score. And we have developed that system in a way that we eventually handed out the first loans more or less on an arbitrary basis to customers to capture a very representative snapshot of the market, and then used machine learning and pattern recognition to actually find out sort of like which of these data points have predictive power and which basically don't. And the system that aroused, that basically, we created from that is now very well suited actually to underwrite thin file people and to eventually allow us to offer credit products basically with a loan application in minutes over web and mobile applications. We can take credit decisions in seconds and basically distribute the cash immediately afterwards, and that 24 hours per day, 7 days per week. And that's basically our value proposition.
So just so everybody understands, and I think this is very important, this company can go into a market which does not have a traditional credit rating agency, credit bureau. They will give out 10,000 loans indiscriminately. They will take the data back. They will create the correlation using big data curves and 50,000 factors. And they will create their own credit curve. And within a year and 3 iterations, they're profitable. And I want people to think about that from their business, right? Within a year, they can go into a country with no infrastructure and be profitable by the year end, lending money to people. And to me, that's pretty revolutionary. So I think with that, thinking that's a little bit on the consumer side, maybe moving on to Christoph, who kind of does something similar, but with the SMEs. Christoph's one of the founders of iWalker. iWalker was founded in 2011, has 100 employees, and has raised $30 million in equity funding. So Christoph, tell us a little bit about your business and how is it different from Alexander's and what you guys do?
Sure. So after so many years of quantitative easing, we are seeing small business lending still in decline. Banks are foregoing billions in revenues by not lending to this segment. Why? For us, it's down to the high cost structure that you have based on your legacy systems. And that is exactly where we have used the last 4 years to build a technology platform to address this and reduce these costs. Primarily, we have innovated in 2 areas. The first is data collection. Our data collection and scoring is vastly automated, which enables us to reduce the operational cost that you have in underwriting customers by 90%. The second is that we are using data that you haven't been using at all in the past, but data that is incredibly relevant when looking at small businesses. And when I speak of small businesses, I really mean those that turn over in the hundreds of thousands of dollars per year and not in the $5 to $25 million. We're looking, for example, in e-commerce at real-time trading data on platforms like eBay or Amazon. This is highly relevant information that in Europe alone covers about 500,000 merchants. By using this information, we understand the customers instantly a lot better than you would do after 4 weeks of manual processing. If you take these 2 points together, significantly lower processing costs and a better understanding of risk by using better data, then you will understand why we are filling the void that you have left.
So yeah, one of the things, Christoph, that I've recognized that's changing fundamentally in the world is that we're moving accounting data up to the cloud, right? So you have companies like Xero and others, and SMEs no longer put their accounting data locally. They put, how is that revolutionary to your business model, just as a thought, as that data becomes more available in the cloud?
It's really critical that information is available either in electronic format or in a way that we can use machine reading tools to understand it and transport it into strings. And then once it's in strings, you can analyze it the way you want and build your models from that. So the availability of data through cloud-based accounting services, payment processors, or trading platforms like eBay, Amazon, Uber, Just Eat, and the list sort of goes on and on and on. Small businesses are using these platforms to operate, to do their day-to-day business through them. And all of the trading data is readily available.
Brilliant. Maybe let's queue up the current advertising campaign for iWalker, so people can have a look at what this means from a consumer perspective.
At iWalker, we're lending to Britain's small businesses, to the early risers and the midnight thinkers, to the passionate, the grafters, the next great pioneers. At iWalker.co.uk, we support businesses with fast and flexible finance of up to £100,000. Apply online with no commitment, and once approved, your business can get the money it needs when it needs it. Apply for free at iWalker.co.uk.
So I think that's so important because that's really where the disruption's coming. This is the difference between a small company going into a bank branch and waiting 3 weeks to get a loan and going online and getting it instantly. And with that, maybe just to think about how we broaden that, we talked a bit about these 2 companies that actually are using their own balance sheet, and we'll talk a little bit later about how they can leverage off other people's balance sheet. But maybe looking at the underlying technology, another really interesting company which I had the pleasure to meet actually in Boston at Sibos a number of years ago is Signify, which was founded in Boston, today has 20 employees and $8 million of seed capital that's come in. Signify. So Jojo, will you tell us a little bit about your business? And I also want you to think a little bit about who you collaborate with, because these people think you probably only work with banks, but that's not true. Okay.
Yeah, good morning. Thanks, Uday. We are actively riding on the mobile money phenomenon, wherein we have discovered that billions of people who have phones actually don't have access to financial services. So we're riding on that, and so Signify is a big data platform that is capable of qualifying billions of customers, underserved customers, who do not have the traditional credit histories or information that will allow companies like banks or other institutions to offer marketing or underwriting offers. So what we do is we use what we call the most ubiquitous data footprint, which is called data records of these people, and then create we gather rich data, how an individual uses the phone, how he sends SMS, when, to whom he sends SMSs, when does he call, how many minutes does he use to call, how much recharges he makes over a period of time, and use that and use our proprietary machine learning algorithms to develop behavioral models that will allow us to deliver scores and leads to marketing companies, to banks.
So sorry to interrupt, but just so everybody understands, let me explain this to you. They look at who you call and when you call that person. So if you're calling a whole bunch of people at 2 a.m. every day, consistently, relative to somebody who calls 50 people across the day, the likelihood is the person who's calling a lot of people at 2 a.m. has a worse credit score than the person who's calling a number of people during the day. And that's the correlation that they're making. And I just want people to think about that and just the size of the complexity of that problem and how they're solving it.
So it's around 500 variables of combination, and then we use that to model. But the key here, as Uday had mentioned, is that we need a telco. So this is, again, riding on the relationships that we've already developed with telecommunications companies before. So we needed to create a value proposition for the telco before they're able to share with us their data. And the data is shared on the cloud. It's automated. It's very, very quick. We just get the data, and we're able to process that in split seconds, and we're able to use maybe at most 4-week historical data on consumers, and we're able to develop models.
Brilliant, thanks, Georgia. So moving on to the next company, another company that we've had the great pleasure of getting to know and really respect. Julian's the founder of Mode, and Mode is firmly in the emerging markets, a little bit like Signify as well, and was founded in 2010, 220 employees, $20 million of equity funding, and maybe as a starting point, a little short video, which will give you a flavor of what they do.
How does Mode change the world? With the little things, what we call nano. Nano is the power of small, minute, almost inexpressible. Imagine millions of transactions daily changing millions of lives at the convenience of the mobile phone. Mode is the leader in the shift of mobile financial services globally through innovation and inclusion. In 5 years, Mode has made life simple. Imagine getting to the train and no money on your train card. In seconds, load it up. Or at the store and need an extra $10? Get it in an instant. Mode does it for you. All this power in your hands. It's private, it's fast, it's flexible.
So, Julian, over to you.
Thank you. So Mode's leveraging again, just like Signify. We started on telco data, started working across the emerging markets, started looking at Africa, spread out to India, different parts of Asia, Middle East. And after the mobile phone became what's the next thing people need, and we started looking at things like utilities, power, water, transport. Just started analyzing everybody's habits in all these things. So in understanding that, it literally opened up this entire base to enable them to access what we call nano. So in understanding next generation, what was clear is we understood that there's power in just $1 now in enabling us to do a lot. I can do a whole bunch of stuff on my Android or on my Apple store just by being able to access $10 or $5 instantly, quickly. And so we built this and started enabling people to be able to just move at, lightning speed by analyzing certain points. And so this is 350 million people later, enabling us to just understand patterns. No matter where we go, the patterns are very similar. Europe, Africa, India, that class of people needing that is a particular generation that's looking for, we're calling it more convenience and speed than they are for too many processes. So that's what Mode does in a nutshell.
Yeah, it's important for people to realize the scale of this market. In Africa and South Asia, there are 2.9 billion people, of which 2.4 billion people have no access to formal financial services, which is why this stuff is so important. Because while everybody is going to be focusing on other segments, this is going to be the emerging segment where you have to start to build a relationship with, and that's why this starts to become so important. And maybe with that segue, some people are probably thinking, what's Neil doing there? But Neil has kind of an interesting role. He kind of sits on both sides. Just to introduce Neil Cross, who's at DBS. For those of you who don't know DBS, given where you are, it was founded in 1968, has only 21,000 employees, and has a market cap today of $31 billion. Neil, your thoughts on this?
I think I got invited up here because I was the only one who dressed down, and they maybe thought I didn't work for a bank. Brilliant. What a great panel to be on. I'm honoured to be with such smart people who've really got to the core of the issue here. It's about how much information and being very kind of scientific about how you get that information, looking at the behaviours. I mean, us as a bank, we feel we're fairly good. We're nowhere compared with you guys, but we have a product where we can do an SME loan in less than an hour by looking at transaction data and align that with financial data, but still a long way to go. I think the real, and this is the great thing I love about fintech, there's places that banks don't play, and fintechs like you come in there and serve that customer need. And I think it's a real wake-up call for the banks is to partner with people like this, because the end result is we're all in this business to improve the financial lives of our customers, whether we have to monetize that or not. And that's what I really love about the solutions I've seen today. It's already bringing around a huge amount of change. I've been in Asia for 10 years, and there are some fundamental issues around finance that need to be solved. And I think Mode, what a wonderful thing. I love to see that. Do you work in Indonesia as well?
Yes, we do.
I have a social enterprise in Indonesia, so I spend a lot of time there. And I think we can take those learnings into the corporate world. So already we're doing a lot of innovation around working capital, getting very deep insight into the operational, financial and operational and commercial aspects of our larger clients, and really tailoring kind of credit products to help them, flatten out the cash flow required for their business to operate. I think that's...
I look at Neil, that's a very important point, because I think the underlying theme of global transaction banking is actually liquidity management for both SMEs and large corporates, right? And actually, at the end of the day, all the people here, what they're doing is providing liquidity to people, which is why I think this is so important to people in the room as well. So maybe we have somebody who's now making his multiple appearance on the Future of Money stage. And I'm going to remind Gottfried, who, for those of you who don't know, is the CEO of Swift, which was founded in 1973 and has 2,163 employees, is that when I asked him last year the relevance of blockchain to the industry, he said it wouldn't be that important for 10 years. I do remember that 3 years prior to that, he said this blockchain thing is quite important. I would remind people that this morning when people went to the blockchain discussion, they couldn't get in because there were so many people waiting outside. So with that, Gottfried, what's your view on how important this is for the people in this room?
I think the question is, when will blockchain replace major processes inside banks? Let's be clear on that. And I still think that will be quite a while before that, even though it's got great promise. So I too was wondering, what am I doing on this panel? I mean, Swift, we do global payments. That's about as far from consumer lending as you can think of. I think I'm also easily the oldest guy on this panel. So I think my role here is to be the natural skeptic and do things that I later say things that I later regret. So I'll stick to that. I had a few observations maybe on this. One, being the older guy, I have learned from banking that the hard part is not making the loan. The hard part is getting back the money, and that typically takes a while, going through multiple cycles before you learn that lesson. But that aside, I'd also like to take this occasion to ask an anecdote that people have told me or that I read somewhere, that with all this data about consumers, in the US there was one of these startups that had sliced and diced all the data, and then they finally found the single biggest predictor of whether people would pay the money back, and it was whether they filled out the application with capital letters or lowercase letters. That turned out to be the single biggest predictor, and when they drilled down, it turned out that the people who filled it out with capital letters did so because they're used to filling out social security forms, which require you to do it in capital letters in the US. And those were the people you didn't want. So I was wondering if people could confirm or deny that anecdote. And then the other observation, which I find a fascinating debate, is we had a similar debate at the London Business Forum a couple of months back. with somebody of the major banks, I think it was Barclays, who was the chief data miner, who said the key challenge for banks is we sit on all this data, including KYC data. We're in a position to ask customers anything we want under whatever we call it, compliance or KYC. The challenge is, are we allowed to use that data? And can we leverage to the same extent that data as some of these startups who have much less constraints around it? And I think that would be an interesting topic to explore here as well.
That last point is a key point. In fact, I think we had a big debate, I don't know if it was here or somewhere else, but I remember, about who actually owns their transaction data. So when you transact on your bank account, and that transaction data is actually valuable because that is your financial history. And without that financial history, you can't get credit. And so is that your data? Does it belong to the bank? It's a big question. I mean, I have a personal belief that it's a fundamental right that it's your data, in the way that Belgium is the only country in the world where it's mandatory to have a bank account as yet, right? And so other countries haven't yet followed, although a lot of countries are moving towards that. Sorry, Alexander, you were going to say something.
Well, first of all, quickly jumping on this point with the behavior data. So we actually also use that ourselves. We look at like typing patterns on the web forms, and we found all forms of like funny patterns, especially, I mean, how long you like hover over the terms and condition button. If you spend a lot of time there, it either means, I mean, you're a very conscious customer and you plan to repay, or you don't want to repay and just want to like learn about the consequences. Getting back to the question around the transaction data. So, I mean, we're a firm believer that we think, I mean, the transaction history is owned by the customer and it's not owned by the institution, I mean, that offers sort of like the service to do the transaction. In fact, I think, I mean, the industry is moving towards, I mean, more or less sort of like opening up, I mean, be it like by, I mean, offering APIs or by having sort of like these aggregators like Yodlee and the services alike that basically allow people, I mean, to take away their transaction history from the institution, I mean, where it was originally sort of like performed, and to share it with other services that want to sort of like do something with that data. So, yeah, I mean, if you would ask me, I think, I mean, that's all about the customer and his decision on what he wants to do with that data.
So that's a brilliant segue to Kevin, because he's going to get the big boys now to give their views on this. Kevin.
Okay, thank you, Uday. So I'm pleased to be joined by the other half of our panel at the back of the room. So what I'm going to do, rather than asking these guys to explain who they are, what they do, I'll very quickly introduce them, but I'll actually ask them to give their thoughts on what we've heard from the front, and maybe touching on the last question that was raised. So the first person I'm going to ask to join us on microphone is Claire Calomagene from Lloyds. So Lloyds was started in 1845, has 20,000 employees. 80,000. Okay, we've just added 60,000, so I'm sorry about that. And 855 billion pounds? Excellent. So we have a balance sheet of 855 billion pounds. So maybe, I'm going to give you a microphone, maybe you could touch on some of the comments that were made at the front.
Yes, I think the word that was coming back all over on the front panel is customer. And we've seen some investment in fintech over the past years for the total amount of 18.6 billion going from VC industry, and most of it have come over the last 2 years, so surely there is a market that is there. But it's not the only one. We have also seen investments and innovation coming from the bank directly. So in Lloyds, we invested 1.7 billion in our transformation in order to serve our customers online, to put 11 million of our customers online and 7 million on mobile. So there is this type of innovation that also exists. And going back to the fintech point and all this collaboration that is going on, we've seen the trend coming from the US quite strongly, and the phenomenon become global with several startups in China, in Europe, and the rise of London as a capital of fintech. What we've seen, so from the bank, from LBG perspective, we have a strong view about the collaboration between the different actors, and not just startups and banks, but actually also government, regulators, where in London we have Project Innovate that is working with us, and also tech giants like Google or Facebook that are also coming on the party in order to create these new propositions that have better services for the customer, simple way to manage money, simple way to serve them. And there is different, I think it's fair to say there is different type of fintech. There is some fintechs that innovate at the core, and they are really in the now and now. And there is some fintechs that really shoot for the stars and are trying to enable new type of infrastructure like blockchain that Godfrey was talking about. And there is different mechanism to respond to integrate them. Some are about partnership and execution of experiments, which we do in the lab. Some about investment, several banks having a fund where they invest in startups, or about acquisition, or some about partnership, and even some banks start to launch their own attackers on some segments in order to reply faster to this proposition. So we see different framework where people answer differently about how do they integrate it. It's at the heart of what I do in my day-to-day as a director of innovation. We created the framework where it's fast, it's quick to enable this way to work. I think there is a big challenge for new startups and young startups that are still, early age, where they have to realize what is it to scale? What does it take to offer services for 11 million of customers in a resilient and secure way, which is at the heart of what we have as a consideration. And through the partnership and through the engagement we have, this is what we are trying to build up.
Okay, so thank you very much. I think you sort of jumped into the next question that we're going to ask, which is about innovation strategy. So rather than asking Steve the same question of what you're going to be doing, maybe you can pick up on what Claire was talking about. What innovation strategy is Wells Fargo doing? So for those of you who don't know, I have on stage, I did have on screen. Steve is the
Chief Head of Innovation
for Wells Fargo Bank. Started in 1852, has a total of 266,000 employees and 1.69 trillion in assets. So Steve, how are you using that to what's your innovation strategy? Are you looking to collaborate or compete?
So a couple things, right? So first, what a lot of people on the front were saying is it's really about data and analytics, and there's lots of new sources. And if you're not focused on that, you're not going to be relevant in 5 to 10 years. I actually totally believe that. And maybe in 3 years, who knows how fast that would happen. The second thing I'd say, and no one take this wrong in the room, even the people on the front of the table, but the smartest people in the world don't work for your company, right? They're somewhere else. And you have to be tapping into people outside your company with all this burgeoning of mobility and all these tools out there. If you're not looking outside your company and figuring out who to partner with, who to learn from, who to invest in, who to be part of, and whatever it's a strong network or a loose network, I think you're missing the boat. And I think those two things are really important. I do want to say two other things, right? I think using data, banks, if you don't think of yourself as an information company, you're not really thinking very smart. I was thinking about the small business lending thing. We started doing faceless lending in small business 20 years ago. That's probably why we're the largest small business lender in the US. But I think to the point of what I'm hearing up front, which I think is really right on, is people are looking at data in very different ways from the way we have in the past, and maybe even how we do currently. And I really think leveraging all these new sources is going to be fundamentally something different for banks to get their arms around, but it's what we're going to have to do. And this privacy issue, I think, is going to be a bigger issue about who really has the data or doesn't. And no one really ever talks about it. But you could make the case privacy is going to be dead. But maybe that's only around location and other stuff, and your financial stuff becomes more a thing where we really have to drive some understanding about how that data gets used by customers before regulators and governments and others step in, which I don't personally think would be a wonderful thing.
Okay, so thank you very much. I'm going to pick up on something you were talking about there, which was the data. So as we heard, banks have swathes of data. The startups are also tapping into other sources of data, so I'm going to hand this one to Lida. So when you're looking at this sort of model and you're looking at data, are you looking at the stuff that you're looking at in-house? Are you looking at external data? And when we talk about a innovation strategy to collaborate with these guys, is that something that you're prepared to open up? And how would you be prepared to do that?
So in terms of the room setup, I feel that I should take a chair and go sit outside just to make a point about how this value chain works. Because given what we do for a living, the Bank of New York Mellon is an infrastructure for the banks. We don't have a retail interface, which means that for us, the most interesting question is what happens between the guys at the front and these guys either side of me and us, and how can we think about our stack in a way that can support this? So it's a fundamental rethink of how we do business. It's a fundamental rethink of how we organize our business, and that's both on the business model side and on the actual technology side and eventually the product side. I'm sure that all of this will be touched on in the 5 minutes we've got left. But on the data piece, we're caught between two very interesting paradigms. One is we have an awful lot of data. We hold information about the organizations that we service and the governments that we service and the institutions and individuals that they service. And that information is, on the one hand, impacted by what the end user wants to do with it, but in every layer of interaction between that end user and my systems, there are layers of regulation and constraints to what can and can't be done. So on the one side, there is the challenge of how do you build the capability that allows you to query that data and turn it into information, and that, for those of us sitting in the technology function, is a great challenge. But on the other side is, now that you can query it, how much of it can you actually draw insights, actionable insights on? So it's a very interesting conversation with customers and regulators around that, because the capabilities that we have built, both in our shop and across the industry, allow us to be smart about things that we weren't able to be smart about before. So we need new regulatory understanding around that. And as you move down that path, to your point, Kevin, you absolutely need to amalgamate that information with the information that is held about your customer next door, because ultimately the way your customer makes decisions has changed, and they don't want to come to you for a certain set of insights and then go next door for a certain set of insights. And that is less a technology problem and a data problem and more a comfort challenge, which the industry is being forced to deal with very rapidly.
Okay, so thank you. So we're also joined here by Angus Scott. So Angus is from Euroclear. Now, Angus, I get the feeling you're going to take this as a slightly different angle. We were talking earlier about regulation, and I'm going to try and sort of see if this chain goes. I don't know where this is going to go, Andrew, but when we started talking about regulation, we're talking, some of the fintech startups we're seeing on the front of the stage are great in their local market, but when they try and enter new markets, they need to partner with people. I wonder if you could sort of comment on how you're doing this with Euroclear, whether you are or whether it's something that you would like to do.
Just to comment on that, if Leda's out of the room behind, because she's the back end, we're out of the conference centre because we really are the back end to the back end. We do have a particular perspective on this because we service major financial institutions, we hold assets on their behalf, and we're all about liquidity management and transaction costs. So the point made earlier about transaction banking is about liquidity, that really applies to our business, and it's how we look at things. When we look around at innovation and fintech, we can see the technology advantages, we can see how you can flatten data structures, and we sit in a very hierarchical data world, and it's very interesting how you could flatten some of those data structures. But then we get very quickly into regulation, and not just into regulation, but into fundamental law, because when you start to talk about securities and balance sheets and so on, you're not even talking just to regulators, you're talking to bankruptcy regimes, to credit hierarchies and so forth, which are really things that have to be addressed when you want to change the way the industry operates. And I agree with Leda, we've got a lot of re-engineering to do of that stack that goes from end to end, but you're not going to do it just by technology. You're going to have to fundamentally rethink some of those relationships between balance sheets, between regulators, between fiduciaries, and the different types of intermediaries that exist in our world. So it's a very exciting time, but there's a very big set of challenges which aren't really technology, they're more institutional and legal that we have to work our way through.
Okay, well, thank you. So I'm going to end my chain with Andrew. Now, we started talking about regulation, and I think one of the areas you were going to maybe twist your words slightly, you almost seem to be going towards culture. And I think when we're talking about working with others, I think culture is one of the key points. And I know that Standard Chartered is a global bank, so you've got people from different cultures from everywhere. How do you integrate inside your institution, and how do you sort of select partners that you work with from that sort of perspective? And is there anything else you'd like to pick up that these guys have said? I'll leave it open.
Thank you. For us, I think it's already been mentioned, this is one of the largest business model innovations in the fintech world, and we've also been quite fascinated with how a lot of these companies are using data for actionable insights and for credit decision making. There are lots of pluses in terms of financial inclusion, benefits to small businesses, etc. But I have to agree with Gottfried that in the world of credit, it's very easy to give money. It's getting it back, which is not so easy. And we are already seeing that in China as the liquidity conditions change or as the interest rate cycle turns, China has already seen a few hundred of these companies fail, and that could well happen in other parts of the world. So there is likely to be more consolidation and integration even within this space. So we should probably hold judgment until a lot of these companies have been through the entire credit cycle. But having said that, one of the things something that we look at as part of our innovation strategy is that while the markets in places like US or China are big enough for a lot of these companies to go out alone and build large businesses, the same is not true for the emerging markets. That's the footprint we operate in. Most of these markets are fragmented. The credit infrastructure varies, the regulatory requirements vary, and therefore the strategy that would make sense for the fintech companies and for the banks is to collaborate. A symbiotic relationship where each benefits from the other, and eventually it's good for the customer. And part of to your culture question, part of the conversations that we often have internally are also around this. How do you change the mindset in a big bank? How do you move away from saying, I want to build everything in-house and build all the systems in-house, to saying, okay, I will integrate with the best possible technologies in the world and therefore be able to move faster for the benefit of our customers. It is an ongoing challenge.
Okay, well, thank you. So what I'm going to do now, I'm going to try and summarize a little bit. So I think what we're trying to say at the back end is we've got the advantage of scale. At the front end, we seem to have the advantage of speed. And if we can bring those two things together, we're going to help better serve our customers. Now, one of the questions we're going to ask the front end, and we're going to try and make this more of a debate now, is what sort of things are you looking for? And we'll come back to you as well, to actually be able to sort of collaborate together. So Uday?
Yeah, I mean, I think the words from the back end are pretty interesting. As I said, the pools of capital all reside there, and it seems like the technology and the cutting edge of technology is coming out of these institutions, partly because of the talent question, or the talent point that Steve made, which I think is a very important point as you think about the future. I also urge people to think about the fact that when Google wants to get into this space, it doesn't really faff around. It just goes and buys one of these guys up, integrates the technology, and then it's out there. And Amazon is now in the SME lending space, both in the UK and in the US. And it's only a matter of time before these guys get in. So maybe just take some reactions on what these guys have been saying and your thoughts about how to collaborate. Alexander.
Well, I heard a lot of talk about innovation coming from there. I haven't heard anything innovative, to be honest. So I think, I mean, it basically reflects a lot sort of like the mindset on how basically people think about innovation in banks. So it's something, I mean, that can happen sort of like in a framework closely entrenched between, I mean, the governance and the regulator and so on. And I think it's probably not what really, I mean, helps to like really fundamentally rethink, I mean, the way how things are done. My point of view is that I think, I mean, we are still at the beginning of sort of like the development of a new ecosystem in financial services. So where each player will sort of like be positioned will basically become more clearer over the next 2 years. I think one of the things that I see will be a likely scenario going forward is that, I mean, banks will probably, I mean, transform into something like where telco providers are today. So I have a smartphone, so I don't really care, I mean, if I have like, I don't know, Vodafone or Telefonica, whatsoever. I mean, they're just a service provider. I mean, the consumer part, I mean, lives basically on the phone hardware and lives on the operating system, on Android and iOS. And I think this is probably something, I mean, that will happen in financial services too, that you have institutions, I mean, who are great on doing the regulatory side, who are great basically on all the compliance handling, who are great on basically having like all the money for all the licenses, and you have basically more innovative services, I mean, that cover sort of like the front end.
Yeah, so you'd say you're turning this industry into dumb pipes, right?
I think that's
basically
where
what
they basically
saying,
just...
right? As we talked about this at InnoTribe 3 years ago around the platform strategy and what that means for institutions, so it's interesting. Neil, maybe just, I'm going to switch over to you. I mean, I can see you're dying to say something here.
Get in there. You got me at banks not innovating. You know, the fundamental thing I'm working on, you know, our innovation group invents zero products. Yeah,
really?
Our job is to turn the entire bank into the innovation group. The biggest thing is culture, teaching them lean startup, human-centered design, doing customer journeys, and getting them understanding the culture of startups and the processes. And that's the thing we need to get to. In fairness, the culture of startups, I think the culture of tech companies is probably more suited to our size, how we have more flattened structures, how we you know, are more ambitious, we experiment more, and then how can we get the nimbleness of a startup? We've reinvented many things. We've reinvented our training programs to be hackathons. We're reinventing our hiring process, how we do finance. We're reinventing stuff inside the bank, which is the single most important thing, yeah? Going out and getting a piece of technology or acquiring a startup and going, hey, that's my digital strategy, good luck with that.
I hear all of this.
You need to reinvent your organisation. I think if you really want to truly compete with the next range of fintechs, the Googles, the Apples, the Amazon, and in this way, obviously, the Alibabas as well.
Yeah, you have to be nimble, right? And I guess I just wanted to turn that around a little bit to Julian, because Julian sits in very different markets, right? It's all great to talk about this because the price points here are so high. But when you think about many of the emerging markets, and I talked about the 2.4 billion people who don't have access to formal financial services, that's a problem that we need to solve. And Julian, I mean, your thoughts?
I mean, I'm listening to the different discussions. It's interesting. But to speak of emerging markets and developed markets, I think the habits that we're seeing, whether in Europe or in Africa, on a particular cadre of customers is quite similar. But 2011, M-Pesa had more transactions than Western Union and MoneyGram put together. Last year, we did 1 billion transactions of Nano. And we're in the collections business. And to the bankers here, I want you to know it's not that we're in the lending business. If you can't figure out as a fintech how to be good at collections, you have no business being in that business. So we're actually in the collections business. And therefore, to be in Nigeria and lend over $500 million and have a 0.3% bad book says we know something about the collection business, right? But when we start looking at the patterns across the world, what we are clear about is next gen. I was looking at the poll up there of who's sitting in this room. It's clear there's a generation coming that's just not well represented, but their demands are very different. So as we innovate inside the banks, what's clear is there's a need for speed and convenience. I think it's Rupert Murdoch who said something interesting. He said, "Big will not beat small anymore. Fast will beat slow." And in looking at that, I'm looking at some of these valuations and assets here, $28 trillion, 1845, 60,000 employees. Yes, we cannot compete with that. But here's serious food for thought is, you're a whale, you have to eat, you're not going to eat sardines, right? So I'm in the business of seeing how the sardine business makes sense to you, while you're in the business of seeing how this makes sense to you. And that collaboration, which I fully agree with, I think is the next integration. There's a lot to learn about what's happening in these emerging markets and where the world seems to be going on particular trends as far as asset financing is concerned.
Thank you, Julian. I see a lot of twitching at the back.
Yes,
go back. But before we go back, I just say Paul Volcker did say recently that the last great innovation of the financial services industry was the invention of the ATM. I just want people to think about that. Back to you.
Thank you. I think that's the gauntlet thrown down. Leader?
No, not at all. I don't actually hear any disagreement in what we're saying yet. And I am saying this from the vantage point of someone who doesn't have a retail business. Mm-hmm. So the way I see it, the moment where we all started having software in our pockets, in our phones, transformed our communications experience, purchasing experiences, banking experience as a retail user. That's a fact. And every industry is feeling that, if you want to call it disruption. It's a change and it's more rapid than other changes, but we're all in the business of change. Nothing has been static for very long. So I think it's false to speak of that disruption as being specific to banking. I think it's happening everywhere, and that's not necessarily the scary part. The scary part, for those of us who sit at the back of the room, is that the new ideas are coming from, and I came from a startup. I did it the wrong way around. I went from a startup to a bank. And the thing I miss the most is being able to have the single-minded determination and single-issue focus, which you can have when you're a startup. You can't have that as a bank. So one of the challenges we're finding is that we agree with everything you say, actually. And we see that change at the digital retail end. We see it at our business, where the end user represents an organization but still has the behaviors of an end user using their phone, right? So all of us feel what you're servicing. But what we have to deal with is an existing set of pre-purchased products that sit on top of a stack. So you won't see the innovation because it won't be that exciting. But when I turn my business of 230 years around to be consumable via API, that allows me to come to you and say, okay, how can we truncate this end-to-end process to make it more valuable to the end user? But it's a journey, and it's a journey that will be slower for us because we've been doing more longer with more legacy systems.
And I think I can see Steve nodding away.
Yeah, just one thing or two. So online banking was created by banks, as was mobile banking, by the way. So I'm going to call Paul Volcker up as soon as we get out of this meeting. The thing that's probably important here, people on the panel, would be how many payment companies new payment companies that started in the mid to late 90s can you mention today, besides PayPal, that still exist, besides M-Pesa too? And I think when you look at those, why did they exist? Because they were filling a market, a customer segment that needed something that the banks weren't filling, right? Now, I think with the behavior analysis you guys are doing, which I think is exactly the right way to think about that is very interesting stuff and using data in brand new ways. And that's why I think this partnering piece is where the game will probably get played more than maybe you would think. I do think there's this big stack that she talks about, but the reality is, it's tens of millions, or hundreds of millions of customers, right, who are looking towards the future, and I think that future is going to end up being probably more a blend than many of us think in this room between the front and the back.
Okay, so thank you, Steve. Unfortunately, I'm conscious of time. I was going to say, could we maybe take one last comment from the back before we throw it to the front? Is that okay with you, Rudy?
Yeah, that's great.
Okay, so maybe if you want to give one maybe last short thought.
I will build on what Leda have said and Steve's, which is, as I mentioned, we see the startups that are innovating at the core, which is also what the banks are doing. Banks are addressing the current need for the customer. 7 years ago, there was no mobile banking. Today, we have 7 million banking online. People want resilient service. They want data security. They want exceptional customer experience. And all of that, you will see most of the banks doing it now through their digital transformation. Innovation is at the edge of that, and it's about enabling the little trends that are going to come tomorrow. And it's about looking at this future and creating option value for it. It's about looking for disrupting business models, disrupting proposition, and that's where the collaboration is key for me. But we should never forget that we are here to serve what the customer wants, and what we observe today is 85% of customer servicing is done online for us. So we've seen a major shift of everybody online. That's what they want, that's what they do, and they are satisfied with it.
Okay. Has anybody else here at the back want a last sort of quick thing? Angus?
So we've talked a lot about innovation in the way you reach customers. From our perspective, it's also very important in the innovation of how you use balance sheet, because banking advantage comes from balance sheet efficiency, not just from customer operating efficiency. And things that improve the use of capital, reduce the amount of liquidity needed, are fundamental. And you may describe that as the pipes, but it's because it's not consumer facing, but it's really at the core of what banking is. And so we need to innovate in that space as well. And there's a lot of exciting opportunities there that that we can take forward. But it's a very different model to how you innovate in the core of balance sheet management.
Okay, and Andrew, last word from the back from you.
To me, innovation is about doing something different that has an impact. It may or may not even use technology, and whether that's for managing fraud risk better or credit risk better or a better customer experience. And a lot of the new fintech companies do enable us to provide a better customer experience at the front end. So I would just reiterate the point of collaboration and cooperation as the way going forward. But on the point of lending, I would still say that it's something where the investors need to be very careful of what they're getting in at this stage, because most P2P companies don't have any skin in the game. The reason the regulators force the banks to make portfolio impairment provisions and do stress testing, etc., is to make sure that the customer deposits are safe and secure. And when investors are putting their money in these peer-to-peer lending kind of companies, those safeguards are not there. So people just need to be very, very aware of the risks they're taking.
Sorry, I'm going to take issue with that, because I think that detracts from where the real market is, right? So it's fine to say P2P may be responsible, what's happening in China. But P2P at the end of the day is a very small part of the market, right? And what we're talking about here is a fundamental shift in the single biggest core business of every single financial institution in the world, which is lending. And I agree that collection is very important. And another time you can hear very much what these guys are doing in collection, because they're innovating very much in collections as well. But I think people have to remember that if your single biggest product, which is lending, which for most banks is their single biggest product, is starting to be disrupted by the people who are sitting here and around them. And one of the things I will mention to you is that I know for a fact that the two people who use their balance sheet here, and actually Julian as well, all of them don't actually fund themselves with peer-to-peer. They're in the wholesale markets. You guys are doing securitization, so you're securitizing your portfolio and going out using that technology. You're going out to banks who are putting in money in the back end. Hedge funds are coming in, providing the debt. So it isn't really hitting the people. It's much more fundamentally reinventing that distribution and the cost of that distribution. So I don't know, Christoph, we haven't talked about your...
Yeah, I would add one point. I think fundamentally, banks have one huge structural competitive advantage, and that's your deposits are state guaranteed, which is also why you have more regulation relative to other lending companies. And you also have a second big advantage. You have very large customer bases because of your long histories. The first one is going to stay. The second one is at risk, as there are other companies who build up very large distributions in the small business and consumer space as well, as the Amazons and Alibabas in the SME space. So I think what we can deliver as a fintech company, we can deliver this integration into these platforms so that actually the lending is integrated into the day-to-day operation of a business, something that very few banks have done in the past. And I think there will be much more cooperation between the new customer-facing companies, the Amazons of this world, and the capital providers, the banks, with some fairly sophisticated technology in the middle who are going to link the two of them.
So brilliant. I think we're out of time. Kevin's about to come and hit me. So thank you very much for all our panelists on both sides.
Very impressed. Well done. Brilliant.
And thank you very much for coming to the Future of Money this year. And we hope to see you again next year for the next big thing. Thank you.
Thank you very much.